Okay, now if you do any analysis, what you guys do? What does analysis mean? Yes, please. What does, when you do analysis, what you do?
To understand the company.
Sorry?
Find out the business of the company.
Yeah, but what technically you are trying to do? What is,
Yeah.
you do analysis, what you're trying to do? So let's say you want to see whether company you give, when you do rating of the company, okay? Or let's say I want to invest in the company, right? Invest in the company, I want to give loan to the company. When we do analysis, what we are trying to do?
To assess the credit worthiness of the company, whether they are able to pay their debt or not.
Yes. So they're whether liable to pay or debt or not, what I'm trying to find. So one is a number, right? One is a number, okay? But apart from number, what I'm trying to figure it out is a risk. Indirectly, when you analyze any company from the credit perspective, what you're trying to see, whether the company can default or not, right? Right or not? So when you're trying to find whether the company can default or not, you're trying to find what are the risks that the company will be impacted by that, or whether the company will be impacted by that. That is your analysis, right? When you're trying to see whether the revenue will achieve or not, what you're trying to see, whether the company can achieve that revenue, right, or not. So when you say company can achieve the revenue or company cannot achieve the revenue, it means there's a risk attached to the revenues, right? When you say the company will be able to complete the production or complete the construction, is your analysis, right? But the risk that company will not complete the construction is your risk. You agree what I'm trying to say? You agree what I'm trying to say? Same way, whenever you analyze any company, indirectly with your analysis, you're also trying to find the risk. Think, take 2 minutes and think about it. Are you doing it or not? When you are saying that this company will not be defaulting next year, okay, that's your analysis, right? But if it is going to default, why? Because there's a risk attached to this, and the risk will ensure that this company will default next year. Agree? Agree? Nikin?
Yes, agree, correct.
So if you want to do a good analysis, you need to find the risk. Okay, what is the difference between credit and equity analysis? What is the difference between credit and equity analysis? So there are two different analyses, right? There's a credit analysis and there's an equity analysis, right? Agree? Now, what is the difference between credit and equity analysis?
Equity analysis more to the cash flow of the company, because they expect to have a dividend by the end of the period, or maybe the fluctuation of the share price.
Okay. And what is equity analysis? Equity is also about cash. See, one thing you always remember, and this is an interview question. Okay. Globally, all the analysis starts from cash and with cash. Whether it's equity, whether it's debt, whether it's any other analysis. You agree with me? You tell me any analysis that doesn't start with cash or end with cash. Can you think and tell me? You can review income statement, you can review balance sheet, you can review macro indicators, micro indicators, business indicators, management. What is your end objective to ensure that whether the company can generate cash or not? Any analysis, and I can guarantee that. Anyone of you feel that this statement is incorrect or may have a different view? Please, I would like to hear. See, you don't have to agree with me all the time, okay? So I told you, in the finance, it's good that people have more views. People should always have his own views, okay? Of course, we all have to respect each other's views, okay? Because you might have something valuable, which I can also learn. So this is a view, and this till now, why I tell this, because nobody has been able to prove that there's anything more important than cash in any analysis. So that's why I'm asking you, do you think there's anything apart from cash which is analyzed anywhere in this world? You think from the bank perspective, what is bank concerned? Whether they will get their repayment and money back, right? An equity investor, what is his concern? Whether company is generating more cash, DCF, right? DCF valuation, end of the day, is related to cash, right? If you go for any other business investments, what is your analysis? In the business, when you put a big project, where the company invests big project, what is the analysis? The analysis is profit or cash. Let's say you're CEO of the company. When you put new project, you put toll road or power project. What is the analysis? Internal analysis. Profit or cash?
Cash.
All the analysis starts and ends with cash. What we are doing are a different means. Okay. Now, when I say this cash, there's a risk attached to this cash. Okay. Clear? Understand what I'm trying to say? Martin? Okay.
Understand, Nitin.
Okay, good. Okay, now I told you what is the difference between equity analysis and the debt analysis. So let's say if you're doing any equity analysis and when you're doing any debt analysis, what is the difference? So again, both is analysis, right? Both sees the same number, but they're two approach. Okay. Now, what is this approach? Like many of you said, equity to assess the value transaction number. Yes, I think perfectly. I think you guys have sent it over here. Debt is more the preservation of your principal and interest. That's my only objective. There's no other objective. Equity, my objective is growth. Equity, my object is the growth in future. Debt, my objective is preservation of money now and in future. Okay, so always the credit analysis is more stringent and more stringent and more conservative analysis as compared to the equity analysis. Always remember this. And this is not because we have to, this is by nature. Okay. Now, it's very simple. If somebody gives you money, he wants his principal back. His focus is only on that principal and interest. That's his main focus. Okay. Now, when we do the analysis, there are a lot of risk attached. Now, why I'm talking about the risk? Because it is through the risk you understand whether that cash, how much cash you will get, or whether your loan is protected or not, or whether you can get your money back or not. Okay. Now, whenever you do the business, okay, identifying the risk, if you can identify the risk, your half of the work is done. And this risk is unique with all the industry-wise, this and company-wise, these all risks are unique risks. Okay, all these are unique risks. Okay, these are not common. You can this is not, you can say, okay, this is business risk, this is market risk, this is financial. No, those are general terminology. Okay, the risk in airline is separate. The risk in Adaro is separate. The risk in power plant is separate. The risk in road is separate. And if you are able to identify the risk, your analysis will be amazing. I'm telling you, you will not go wrong. Okay, now let's do one small exercise. Okay, what is the exercise? Okay, Garuda. Okay, Garuda we all know, right? You all know Garuda, right? Now you can use any framework. Okay, any framework means whatever you want to use. You want to use from here. What is that? Where is that gone? Okay, sorry, I think I have erased. Okay, this one. Sorry, I erased it, I think, by mistake. Okay, did you guys copy that? You want me to write again? You've copied this?
Yeah.
Yeah.
Yes.
We
Yes.
already.
Okay, good. So now I want you to understand one thing. What is the business risk or economic risk of Garuda Airline? Simple task. Simple task. Okay. When you're writing this risk, okay, I don't want you to write some general thing. Okay, please. I don't want general thing like market risk, business risk, exchanges. No. You have to be very specific. Okay. Okay, I'll give you one example. Now, one of the biggest risks in Garuda is oil prices. You agree with me? This is a very
Yes.
specific risk for Garuda.
Yes.
One of the specific risks of road. What is one of the specific risks of road? What is one of the very important risks of road? Anyone has done road analysis? Yogi wants to.
Do you mean toll road?
Toll road, yeah.
Oh, the market risk, I mean the volume traffic.
Traffic, right? This is very specific risk. So if you know the risk, what the next thing you will do? If you know the risk of the toll road is traffic, what is the next thing you will do? Niken?
Focusing on those risks and assessing how the risk will affect the cash flow.
Yes, you will go detail into that. What the next thing? Once you know what is the risk, next thing you will do a traffic study, okay? You will hire a third-party consultant, or you will read the traffic report, see what is mentioned in that. You will do the sensitivity of the traffic study and see finally what is the impact of this sensitivity on your cash flow. And then you will form the view whether this number is good or bad. You understand? Okay, this is how you have to identify the risk and use that risk to find or see the impact on the cash flow. Very simple. I can talk about full day about risk, but that's not the point. You have to identify that risk. Okay, now let's do exercise. Okay, so now what I'm going to do, I'm going to break you guys into 4-5 rooms. Okay, 4-5 different rooms automatically. Okay, I'll give you 15 minutes. Okay, 15 minutes. I want you to tell me the risk specifically for Garuda Airlines. Okay, you can talk about industry risk, sector risk, company risk, but be more specific. 15 minutes. Okay, you can use Excel file and just start putting it. Clear? Clear?
Clear.
Yeah. Clear.
Okay.
So I'll put it 15 minutes you have. Okay.
Okay.
Okay. So I'll create. How many people are there? 1, 2, 3, 4. Okay. I'll 4.
15.
Okay. I'll create 4. 4 is okay, right? Or 5. No, we are just 1, 2, 3, 4. We are 12 people, right?
Yeah, 15 people, so maybe 5
15.
rooms.
Or 16. Okay. I put 5. Okay. I'll just put that. Okay. So let's start. Put this in Excel or PowerPoint, whatever you want. Just you have 15 minutes, but 1, 2, 3, 4, 5. Done. You guys are here.
And later, Corey, you may add on, yeah. Feel free to jump in. So for revenue, the risk that may impact an airline's revenue is natural disasters and geopolitical unrest, which may impact the demand risks of the airline itself. Substitution as well, with that being with other modes of transportation or other airlines, most of all LCCs. Yeah.
Okay, just 1 minute. So geopolitical is also your economic risk, right? Economic or your country risk, right?
Yes.
Okay. So,
yes.
Okay, the same risk can impact two segment. Okay, it's okay. But this also okay. So what substitution? What do you mean by substitution?
Like for instance, like in Jakarta now, there's the Trans Java Toll Road which connect the Jakarta to Surabaya. So that may substitute the demand for airline, even though to some degree, not to a large degree, but to some degree, it may impact the demand for airline itself. Maybe for not for maybe for shorter like maybe for Jakarta to Semarang, because of the connectivity, the toll road is already connected. It may impact the demand for short haul route. Yeah.
Okay.
So yeah.
Okay, so I got it. I think one of the point which I liked a lot for the revenue. Okay, because you only do you don't move your sheet. Okay, this is enough. You don't have to move. So one of the point which I liked about this is, this pricing cap.
Yeah.
Airline business is a very sensitive business. When things going good, government don't want to increase the price, and when thing going bad, the prices are as low as water, right? So this is actually a very big risk for the airline. They cannot make supernormal profit ever in their life. Okay, and that's the reason why many airline companies in the globe are losing money, except few. Okay, so this is a very important risk. Okay, good. So I think this is okay. Okay. Now, anyone want to add anything over here in the revenues? Okay, just we're talking about the revenue. Okay, you can stop sharing now.
Okay.
Okay, so anyone wants to add anything on the revenue side?
Maybe from revenue, because revenue consists of price and volume. Don't know whether you guys already highlighted in terms of like demand risk or the volume risk, yeah, in terms of low occupancy
And in fact,
rate, in terms of like the seat, maybe if the seats are the seats that are sold, maybe in terms of low volume,
yes,
and it could also affect the revenue.
yes. Okay, so now let me ask you a simple question. Okay, so let's say occupancy. Okay, now occupancy is a major risk. What Nikan is saying, right? Whenever the market is down, the occupancy is low. When market is high, occupancy is high, but price are low because government put the cap. Now tell me, if you're evaluating the airline company, how do you put that in the cash flows? I mean, how do you do this analysis that gives you comfort in the projections? Simple question. Anyone? You understand my question? You understand my question?
Repeat the question.
So question is, occupancy is a risk, right? In the airline. So anything like toll road, power plant is a load factor, or the toll road is traffic, airline is occupancy, number of seats people occupy, right? That's a risk, right? Tomorrow you're flying plane with 10% occupancy, 25%, you will not be profitable, right? Now my question is, if you are doing the rating of the airline company, how you would analyze this number and take the number that gives you comfort? How? So let's say I am the owner of Garuda. I will say my occupancy is 90%. Now tell me.
Peer benchmarking. Is it normal for an airline to have a 90% occupancy that particular route?
But how you will get that
compared
data?
to their peers?
How you will get that data?
For maybe we benchmark with the peers that are listed in the IDX. That's the close, yeah.
Okay. Okay. So of course, yeah. So one is of course the peer which the data, but problem is that data you will not get route wise. You will get a general occupancy, which you will get. So that is one way of doing it.
Yeah.
Taking some historical number. Now, another way of doing it is to ask the company to give you route wise occupancy numbers. Company can give you this data, right? Route wise occupancy. Take that data and analyze. Now that is where once you identify the risk, you can go deeper. Okay. Now when I say all the risk, okay, all the risk you should not go behind. Okay. So if I ask you, Yogi, what is your problem in life? Okay. Yogi will give me 100 problems, right? Possible, right? We all have 100 problems, right? But that 100 problem out of 190, we don't need to focus on because that will automatically take care. If today Yogi has to wear the mask, that's also one of the problems. But do he need to worry about that? The answer is no. Okay. So whenever you identify the risk, it doesn't mean that all the risk you have to go deeper. The focus is risk which impacts materiality on the cash flow. You need to go behind and go deeper into it.
Are you saying that we should focus on the, let's say, the major contributor, which routes that significantly contributed to the revenue, or check the seasonality as well?
Yes. So again, like I'm not giving you answer. I'm giving you one general solution. The solution which can be applied. What I'm trying to say that, let's say revenues, my friend Yogi has given me 10 risks. Okay. Now, do you need to go behind 10 risks? That's my question. Because you also have time limit, right? I'm sure that, do you guys, how much day you need to turn around the rating?
30 days.
20 days, right? Now 20 days, you need to understand the company, sector, financials, projections, everything. Prepare the report, present to the committee, get approved from your boss, everything, right? So technically, what I'm trying to say that all the risks you cannot go behind. It's not possible.
Yeah.
See, now if we just write from 5 group and 5 group give me 10 different type of risks, then there are 50 risks, right? My question is, can you cover that 50 risks? If you can cover, it's very good. Okay. But you try to see the major which impacts the cash flow, material. Okay. Now that material you have to decide. Now, for example, what Nikin is saying, there may be 100 routes, but do I need to see all 100 routes? I will ask data, but I will quickly see which are routes which are non-performing. And I see what is the impact of that. Which are routes are high performing. What is the contribution of that? That's my work done. Because if you go behind 100 routes, you cannot analyze. You just miss. So you have to balance somewhere. Okay, that's my point.
Yeah.
Okay, Nikin. Okay. Okay. Room 5. Okay, good effort, Yogi. Okay, good one. I think Yogi has written a lot of things. He was hiding because he have written so many things. You don't want to show the secret analysis. But your analysis was good. Okay, so okay, room 4. Okay, room 4. Next one. Pick anyone and just talk about one. Who is in room 4? I forgot. I can.
Hello.
I have. Tell me. Aryo and Aguntas.
Yes.
Oh,
Hello. Yes. Can you hear me?
Oh, by the way, room 5 was Nikin and Satria.
Oh, we forgot. We forgot.
And my friend,
number 3.
Where's Yogi? Yogi is in room 1. Oh my gosh.
Oh.
I have problem with you, room 1.
Okay. I thought we're number 3.
Okay, no worries. Okay, Yogi. Okay, let's go with room 5. Nikin. Okay, let's go. Because 5.
So room 5, yeah.
Room 5, Satria and Nikin. Okay, one of you. Okay, just pick up one. Just pick up one if you want to talk. Okay.
Okay, so for the country risk, we pick the regulatory risk, particularly related to the travel restriction or travel ban, which will affect maybe the volume risk. Maybe we also affect maybe, let's say, like seasonality, because sometimes for the Hajj route, there's only specific months, and there's like maybe and as well as related to the there may be traveler ban
Okay. Okay.
coming to Indonesia from certain countries.
Okay. Okay. So, and economy, you put oil and foreign currency mix now, or foreign currency. Now, this is very important. Okay, especially for airline company. Now, tell me. Okay, oil. I'll come later. Okay. Now, in airline company, regulatory and foreign currency are very two key risks, right? Now, regulation, like I said, there can be all kind of regulation. Airline company, if any breach is there, there's a lot of issue. We always hear about airline because safety of the people is very important. So now COVID is one of the biggest example how airline is impacted, right? Now, the important is this foreign currency. Now, tell me how this economy and the fate of the airline company is linked.
In terms of maybe like the asset procurements, mostly in US dollar for the airplane, and while maybe the revenue mostly contributed in let's say if it is generated from local currency from domestic route, so there will be like a mismatch between the financing to procure the asset with the cash flow generated in local currency.
Okay. Okay. So my second point is, so let's say a airline company in Singapore, okay, or airline company in Indonesia, an airline company in Africa, right? Okay, or let's say airline company in Zimbabwe. Okay, Zimbabwe has very high inflation rate. You know that or not?
Yeah.
So in Zimbabwe, the inflation rate is very
Zimbabwe.
high.
Oh yes.
Yeah,
So Zimbabwe, the inflation rate is very high. So technically, the currency is like 20 billion. A $20 billion currency. So like $100 billion, 10 billion. Now tell me how that impacts the airline company.
Inflation, you mean inflation?
No. I'm talking about how country impacts exchange rate. See, so if you airline company, which is more easier country to do business, Singapore, Indonesia, or let's say Zimbabwe?
Or Singapore.
Singapore, why?
Because it's like a hub of the.
No, I'm talking about. I'm talking with respect to foreign currency, very specific.
Oh, okay.
I'm talking with respect to foreign currency only.
Yeah, in the case of Singapore, maybe there is the foreign currency mismatch will maybe lower because mostly the revenue will be generated from, let's say, US dollar to match with their costs.
No, but that is also Indonesia, right? Singapore generate revenues SGD, they pay in USD. So Indonesia, they generate a revenue in IDR, they pay in USD. But why Singapore is better in terms of foreign exchange?
I think it's about the fluctuative side of IDR compared to SGD if we exchange it to the USD.
No, it's IDR and USD and SGD and USD. So basically it's about fluctuation. Okay. So Singapore currency is very stable. See, if you have a stable, you still don't get impacted, right? When you get impacted, when there's a fluctuation, when suddenly there's a depreciation, suddenly there's appreciation, you get impacted, right? So you don't want that. So this is how country with a stable currency does better in airline as compared to currency which is a fluctuating. You see the linkage of this country and this. So let's say you have to analyze a country, which is airline company in Singapore, you'd find this exchange is not so important. But in Indonesia, India, Vietnam, this is very important because of fluctuation. Okay. So there are other factors as well, but these are broad factors. Okay. Okay, let's go to another one. We have to quickly do it. Next group, quickly, room 4, Argo and Aguntas.
Yes, hello, this is my.
Can you take cash? Sorry.
Hello.
Cost. Can you talk about cost?
Yes, correct. Pak Nitin, Mr. Nitin. So I think our teams, I think, focus that there is maybe the main biggest problem is the GA is their cost, as their releasing price for their aircraft is very high. based on the news that we heard that the releasing price for the JA airplane is 4 times higher compared
My God.
to
Is
peers.
it?
Yeah.
Is it?
Well, we heard in
Okay.
Huh?
I don't think so.
we heard in the news.
No, I don't think so. Anyway, okay, let's not.
Okay.
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 FX. Okay. Now,
So
yes,
and the
go ahead.
second thing is I think is their energy price is second biggest component for in the aircraft for in the cost structure. So it's affect their margin, and if the energy price is higher, it will impact, it will them their margins, and their foreign risk. Yeah, if the mismatch currency between the revenue and cost. And as I am understanding, yeah, for the Indonesian SOE could not fully hedge their cost, yeah, because of the regulation. I don't know, correct me if I'm wrong for that view.
Hmm.
I think that's our opinion for the risk for in Garuda cost. Yeah.
Okay. Any other cost? Only these two costs? Any
Hmm.
other cost? Anyone wants to add any cost quickly? What other thing? Anyone who has written something extra in the cost?
Maintenance.
Oh,
Maintenance.
maintenance cost. Yeah.
Okay. What else?
Okay.
What else?
Personal costs.
Personal cost. Okay, but personal cost. But how that's a risk?
Yeah,
Some-
during the low revenue generation, it will be like a
Yeah.
fixed cost, but usually it's actually variable cost. Yeah, if the revenue is could match the cost.
Yes. I think somebody wrote about manpower, quality of manpower. You know that there's not enough pilots. Singapore import all the pilots.
Hmm.
Oh
Okay,
yeah,
so quality,
availability of talent. Yeah.
yeah,
Good
the
if-
pilot is very scarce resources. Okay, okay. What else? Somebody wrote about the crash or technical.
Engine failure. Yeah, insurance costs.
Okay, technical issues very important in airline. You saw that, right? One accident and people start. The insurance cost goes up.
Hmm.
The people stop flying. All these are your costs, right? Indirectly. Okay. Okay, good. So there can be many other. Okay, so don't worry. Okay, now you have to see. Okay, now how deep? For example, let's say if you want to see energy price. Okay, now energy price. Again, my question is simple. If Garuda comes and say, please see whether you analyze this rating for credit for us. Okay, what do you have to do in energy price? How do you get comfort? Anyone? How do you get comfort? Anyone? Whether the $100 okay, $50 okay, $60 okay.
Maybe we will get projection data maybe for projected energy price for another maybe next 5 years, and then we sensitize our projection based
But how you will
on
get
those
that
data
next 5-year data? You know that
from Bloomberg or from other source,
Bloomberg
something like that.
Bloomberg also
Or
gives Bloomberg also gives for 1 or 2 years, nothing beyond that.
oh, okay.
So we were doing one transaction. Okay. Now energy price, you are trying to project the energy price for 5 years. We couldn't find the data for 5 years. We hired a consultant. Consultant said we can only give projection for 3 years. We don't have model for 5 years. Then how you do it? Commodity. What is the problem with commodity? This is commodity, right?
Yep.
So 1 year it may go to 100, next year it may go to 40, right? In 2020, the price became negative, right?
Yep.
Remember? Any of you? The price of the barrel became minus 10,
Yes.
10 or 20. It means that if you take oil from somewhere, they will give you money. Now, this kind of situation is very difficult to predict. Okay. Now, how I have done that, I'm just giving you a simple example. So we had taken the oil price movement for last 30 years. And we have found we have founded the compounded annual growth, and we have taken that because we have to project for next 5-10 years, right? This is how we have done. But the many times you may not get the data. Okay, so you have to understand what you can best take. Okay, so for us, that was the best we could take. Okay, the company has projected very low number, but we said no, we take last 30-year data because last 30 is quite long data, and we applied the growth rate based on that. Everybody said that we cannot project more than 2 years. Everybody, we hired the best consultants. Okay, clear. Room 3 quickly. Room 3 and room 2 quickly. One.
Hello.
Yes,
Yeah,
go ahead.
Nitin.
Go ahead. Go to FX, financing.
Okay. For team 3, I'm with Martin and Agung.
Yeah. Financing. Yeah. So FX exposure. Yes. Go ahead.
Yes, it's the same with before. Maybe the difference is liquidity risk.
Okay.
Because the Garuda is managed huge debt in 2020. Maybe that some point in cost that not present yet from another team is limited airport capacity, Nitin. So we feel there is a risk the airport density that could reduce the Garuda productivity.
Yes. I think this is very important point. The data said that 2 years back when Mumbai airport was expanding, average how much time the airline was flying in the air before landing? How much time they were flying in the air before landing? Any idea?
8 hours?
No.
In Soekarno-Hatta is around
just waiting in the queue to land, not flying.
Yes.
Waiting in the queue to land. You know how many hours?
Hours.
45
Indonesia maybe around 20 minutes.
45 minutes to 2 hours.
Whoa.
Okay.
That's a whole flight, normal flight.
Yeah, that's a normal flight, right? And that is the cost. Okay, good point. Okay, good. Okay, I like the point. Okay. Yes, somebody is saying something. Okay, my question. Okay, last the team 2 quickly. Marshall, Krishna, and Hanta. Okay, go ahead.
Yes.
Go ahead. Who's talking?
Oh, Tita.
Yeah, we identify some factors. Yeah, one of them is high lease rate, just like the others says that Garuda Indonesia has so many lessors. Yeah. So if we see the balance sheet, one of its debt is more than 50% of its debt structure is lease debt. Yeah. So I think it's one of the major risks of Garuda here. Also, we note it has high exposure to fuel costs. Yeah. As we know that its margin is quite thin. Yeah. It's EBIT margin. I mean here it's quite thin versus its exposure to fuel costs. Also that we know since 2020, Garuda Indonesia is highly impacted to the pandemic. So it has a severe impact to its traffic. Yeah. So it lose making money from Hajj, and also it's one of the most factor. Yeah, we have to assess.
Okay, so I stand. Okay, group 2. See, you have identified the cost. Okay, you have not identified the risk. Okay, so what I wanted was risk. Okay, so like risk in your case could be fuel price movement. Okay, that's your risk, right? The pandemic is more like your, either your country risk or sector risk, right? High OPEX is more operating risk, right? So basically you have identified the cost. Okay, so the cost we will do tomorrow, don't worry. What I wanted to identify the risk, because if you know the risk, then you can analyze the cost properly. That was my objective. Okay, so what you have said is right, your analysis is right, but try to identify the risk first. Okay, then you can identify the cost or revenues. Okay, for example, working capital, you should have told like inventory, like working capital is liquidity risk, right? So how much working capital they are keeping, that will come in the liquidity risk. Okay, for example, you're talking about traffic decline is a traffic risk. Okay, this is your traffic risk. Okay, now traffic risk will lead to the fall in the or a change in the traffic, which we discussed in start, right? And likewise, okay, we have already discussed that. So please focus on the risk first. Okay, all this breakup we will do tomorrow. I mean next class. Okay, all the cost. Okay, okay, good. Okay, guys. Okay, all good. So now all good. So again, my objective for doing this exercise was very simple. That I wanted you to focus that there are 5-6 framework. You try to identify this. Ensure that you cover everything. Okay. Now, quickly, I give you 5 minutes only. Just 5 minutes. People can go for the. Okay, I'll give you 5 minutes. Not 5 minutes. I also need a 10. I'll give you 10 minutes break. Okay, 10-15 minutes break. Okay.
Nitin, sorry, Nitin.
I'll give you 15 minutes break, 10-15 minutes break. Okay. What I want from you is people can take a break, and people who are here, just we'll start after 15 minutes. I just want small exercise. Okay. Since you are going in the break, you can think about it. Just tell me what are the risks of the graph. Just everyone write on the chat one risk on the graph. Okay, you can take 5-10 minutes break, go for a toilet break, drink water, whatever. Sorry. Okay, I'll give you 5-10 minutes break. But in meantime, while you're in break, if you can think what are the risks of graph, just put on the chat.
What is the risk of what?
Grab, Gojek.
Grab Gojek. Oh, I see. Okay.
Gojek business. Okay, you all been in Gojek, right? Tell me one risk. And you see that over here, you will find enough risk. And if you can focus on this, you can do good analysis. Okay? Okay, now take break, please, because, the next session when we start with some financials numbers as well. So please take a break, okay?
Nitin, hello?
Yes, please.
Karnik, can I have a question for you, or should I wait after this the Grab case over?
You can ask. Now it's a break time. So give me break also for 5 minutes.
Okay then. It's okay. It's okay. I just something that make me curious about.
Okay, go ahead.
The race.
Go ahead.
Shall I ask now or wait you for 5 minutes to break?
No, you can ask me. You can ask.
Okay then. So how you determine about the what is that the particular risk that that very major risk for one company?
Or what?
What? So for example, for Garuda,
yes,
how could determine that? Okay, this risk is the biggest, the heaviest that we need to be concerned. So
okay, good.
Yeah,
what is it? Is it will be the risk will be that a default or something like that, or is there any what was called? There's a rule or something like that.
Yeah, maybe if I could also touch on that also, Nitin, if I may add on, you said that materiality does matter, yeah, but what if out of 30 risks that are identified, just for example, 10 are the ones that are may materially affect cash flows. So do we need to go deeper on those 10 particular risks, or just focus on let's say the big 3 or the big 4 that may significantly affect the cash flows, even though the other 6 may also affect cash flow in a material way? Yeah.
Okay, I think both questions are very good. I think let your team member come. I will answer both questions.
Okay.
They can
Yeah.
answer
Okay.
that from it. Okay.
Thank you, Nitin.
Okay, thank you, Nitin.
So for your question, Arya, your question is how do we identify which is important risk, which is not important risk, right? In short.
Yes, yes.
And Yogi is that when materiality out of 10 risk, do we just leave 5 and just focus on 5, or we do all? How do we decide, right? So both questions are good. Let's come after 15 minutes. I will explain this. Okay.
Okay. Thank you, Nitin.
Okay. Hi. Sorry. Okay. Hi. So now, just quickly, because I asked you one question, right? So answers for that. Yes. Sorry, I put this because I wanted to write something on the screen. So that's why I needed this. Okay. Okay, now quickly, all the risk. On every one of you should send me one. Everyone has, I just got from few. Come on, at least write one. At least write one. Okay, I'm reading out, okay, quickly in 2 minutes. So, so my friend says competition. Yes, very big. I think the biggest risk in the Gojek is competition. You know what is the biggest risk in technology business? Biggest risk in the technology business? What is the biggest risk in technology business?
Regulation.
I'm sure that in future you will do a lot of rating of technology from Indonesia because the sector is growing. Yes, sorry. What is the biggest risk?
Regulation.
Huh?
Regulation.
Regulation. No. Technology has zero regulation.
Evolution of technology.
The biggest risk is technology. Technology.
Oh.
The biggest risk of technology is technology. Because technology is something which anyone can do. Okay, let me give you an example. Can anyone set Alphamart in Indonesia very quickly in 1 year, 2 years? Can anyone do that? It's difficult, right? You need money, you need network. But it's very easy that in next 2 years, somebody can create a technology company which is better than existing technology company. Okay, so that's a good, okay. Shifting behavior, yes. Online to offline, I think that is not so much. Okay, human capital, biggest risk, okay. Okay, regulation, okay, regulation, yes, there is a risk, but not key. Okay, regulation, high investment require high technology, high penetration cost. Okay, operation cost is very high. Okay, tight competition, competition risk, yes, competition is very high. Valuation risk, what do you mean by valuation risk? Sorry, I didn't understand.
Valuation risk means that if venture capital wants to assess the valuation of the startup company, I have faced many occurrences that the startup is overvalued, like the real value is below the value that they issue. So yeah, I think it's a valuation risk for the startup company. So yeah, I think it's a detrimental for investor because
Okay, I understand what. Okay, I think that's a good point. I didn't think about it. Okay, so what he's saying that expectation mismatch. Okay, now when there's expectation mismatch, you know, people will not invest, or people will not invest, or people will overinvest. Okay, let's say tomorrow you start a business and you want valuation of $5 million, venture capital may not invest. So there's a mismatch in valuation. Okay, so that's what he's trying to say. Okay, good point. I missed that point. Okay, market penetration is okay. High subsidy for his services. Again, that's how there's a risk. Less loyalty. Less loyalty is a risk. I can understand. High subsidy for the service, that's not a risk. I don't know what you're trying to say, but yes, loyalty, I agree. Customers are not loyal. You know this this payment business, payment wallet, yeah. You have your OVO, right? OVO and all this thing. You know that the research says that people are only 5 to 10% people are loyal. Rest 90% people are not loyal. So people only go for discount and freebies. So people only go for discount and freebies. Okay, so that's a risk. Okay, Okay, so if this kind of business, do you think, you know, it's so how you will analyze the credit, high credit or low credit risk? If the customers are not loyal,
High credit risk.
high risk, right?
Yes.
So in the toll road, customer are very loyal, right? People cannot fly.
Yes.
Okay, electricity, people will use it, right?
Yes.
Okay, coal, people will use it. But this one, people don't want. If somebody comes, give more discount, people will move there. So very high risk. Okay? Risk of new technology. Technology, I told you, technology is the biggest risk in this. The biggest risk of technology business is technology. Always remember this. Okay, I think good. I think all of you have written cybersecurity risk. Okay, good. Okay, so I think, right. So if you ask me 3-4 big risks, one is technology, second is people. Okay. Third, the biggest is a loyalty. Okay. So that's why the people like business which are more loyal, you know, like business like subscription-based business, like Zoom. Why Zoom is valued so much? Because if you take Zoom now, I will take for next 5 years. Okay, but I buy only one time, I don't use it, that is not very good business. Okay, so these are 3-4 important things which are important. Anyway, so let's come back to the two questions and then we move ahead. Okay, the two interesting questions from your friend, I think both are very interesting questions. Okay, so first question is that how do I identify which is a high risk, which is a low risk? Okay, how do I judge? Okay, anyone wants to answer this? How do you judge? How do you judge that that traffic is a high risk or low risk? Or how do you judge fuel is a high risk or low risk? Because like I said, you cannot do everything, right? Okay. So how do you do that? Yes, please. Anyone? Anyone want to answer this? Please help me. How do you identify or tell that this is high risk, this is low risk, or this is a is valid question, right? This question is valid.
If it impacted its cash flow.
But I think, you know, all the risk may impact the cash flow, right? So it's not about whether it impact the cash flow, because if it's risk, technically, okay, what is risk? Risk is that probability is that there's a probability that it might impact you. That's a risk, right? Risk, if there's no probability, that's not a risk, right? So probability is there, so it will impact you somewhere, right? Now question is, how do you identify it's a high risk or low risk? Okay, Mike, anyone wants to take a try? Martin or anyone? Okay, good question. Okay,
we can say.
Yeah, go ahead. Go ahead. Go ahead, Aspen.
Yeah, I think we can say it is a high risk if it materially impacted to its cash flow, or business continuity.
Yes.
I guess.
Okay. Yes, I think she used two right word actually, materiality and continuity. Okay, think like this. When you are in business, you always surrounded with risk, right? Because if there's no risk, that's only dream business. You tell me one business which has no risk. Anyone? Not possible, right? If you're in business, there will be. But do you think we should be worried about all the risks? The answer is no. Anything which impacts you materially. For example, let's say tomorrow the revenue might go by 5-10%. Okay, do you think you should be worried? Yes and no. If the margin is low and that 10-20% your cream crowd who's contributing to margin is going off, it's a risk. Okay, but if my volume is very high, this 10-20% doesn't matter, is low risk. Okay, now I'll give you a simple example. Okay, Ramdev, this is your question, right? Okay, now tell me, when you go in flight, you wear your seat belt, right? Okay, when you go in car, you wear your seat belt. When you do cycling, do you wear the seat belt? No, right? Now that is what is material, what is not material. Now think, why when you cycle you don't wear seat belt, but when in the car you have to wear the seat belt?
The speed is different.
It's not speed. It's because it's a risk. In the card, if you're hit, you
Yeah.
might get impacted severely. But in cycle, you may not get impacted severely. Okay, that's one thing. Now, the second important point in this, it's stage, which I'm going to explain in a little while. What is the nature of business, stage of business? That is also important. Okay, think like this. Tomorrow, do you think there is a second Grab which can come in Indonesia? Do you think there's a chance? Do you think that another Gojek might come in Indonesia? Anyone will invest that? Gojek is losing money, right? Every year they're losing billions of dollars, right? Do you think someone has so much of energy to start this business from scratch, where they might have to lose double the money as Gojek? Do you think somebody will come?
No.
I think so. Highly unlikely.
Don't think so. Okay. Now, but let's say there's a small company startup which just started. Okay. Do you think someone can come and displace them? The answer is yes. Okay. Do you think that tomorrow, again, I'm just trying to give answer to him. Okay. Astra revenue 5-10% goes down will impact? I don't think so. Do you think your rating will change if Astra revenue will fall by 10-20% for any particular year? May or may not. Okay. But it may not impact, right? But let's say a company which has a low margin, the revenue falls. Yes, it's a material. Okay. So you guys have to decide what Stania said is perfectly right. Continuity and materiality. Okay. If you think that the risk will impact majorly, you have to focus on that. Okay. Don't focus on risk. Let's say the profit is $100 million, and let's say a risk which might impact 50,000. You are searching for that. Don't do that. It's waste of time. Okay. Okay. What was another question I forward? Yogi, right? Who asked that question? Another question. What was your question? Somebody asked one.
Yeah, I asked about if you said that if there is 30 risks, if we identify 30 risks, but out of those 30 risks identified, 10 risks is the one that materially affect the cash flow. So should we focus on those 10 risks given the time constraint? Or should we just focus on, let's say, the big 3 out of those, despite the 7 others are also does materially affect the cash flows as well?
See, ideally, you should focus on all, but you always focus on material, okay? But sometimes remember, I'll give you my own personal experience, okay? And then you will say that that only material. When I say material, sometimes non-material risk can be very material. Okay. Now let me give you one example. Okay? So this example happened, when I was doing this, power plant. Okay. Just give me 1 minute. I'll just explain. And you tell me, okay, whether what I should do. I'm just sharing my screen with you. Okay, can you see my screen? Okay, so this was a power plant. Okay, this was a map. Can you see my screen?
No,
Not yet.
Not yet.
No, sir.
Sorry. So this happened to me in my actual, my actual analysis. And I tell you the risk. Can you see my screen now?
Yes.
Yes.
Yeah.
Okay. So this happened to me. So I went for we were supposed to analyze this project. Okay. This was power plant at that time, coal based. Okay. Now you don't have coal based power plant, or US stock. Banks are not financing. Okay. I'm talking about 10 years back. So this was a power plant, and I went for a site visit. Okay, site visit. So at that time, the construction not started. Okay, so I was writing a note about this company to fund this company. So when we went there, so all this land So it was like this, okay? Just very simply, it was like this. So all this land was a government land, okay? And there was around 10 small houses. 10 small houses, only 10, huh? 10 or 15 maximum. You know that small, temporary houses, people slums, people stay. So something like that. So we went for the site visit. The owner said that these lands are government land. So he already showed us the order. Okay. That government has given that land to him. And this land, he said, is a private land which he purchased. So he showed us paper. Now he started construction the power plant here. He already started at that time when we had gone. Okay. So this was there. So he took us in the car. Okay, we went around, and there was 10 houses, 10 or 15 houses. So then we said that, what about these houses? So he told us that these are the poor people, and they just want more money. So as soon as we get the money, we will just pay, and we can remove them. It's not a problem. They are good people. They will listen to us. Now tell me one thing. And this is the entire land which he acquired is 99% land. Okay, this is just 1% land. Now this is a risk, material risk or non-material risk?
In terms of percentage, it is immaterial, but in terms of risk like environmental risk, and then accidents, if the construction begins, it will has material impact to the company.
So construction is away. It's not nearby. It's enough place. So this is too much difference, So this is a big plot of land. Okay, this is like, I don't know in hectare, but it's like 1,500 acres. This is a huge parcel of land. Huge. We needed the car to go around. Okay, so it's as huge as that. Okay, so this is just small 10, 15 houses. Okay, I'll give you my view. Okay, when we have gone, for us, this was not a risk. Think like this: if somebody can acquire 99% land, can he not acquire another 1% land?
Yeah, high possibility they can acquire.
It's very easy, right, to convince someone, right? So we have analyzed, and I said this is no risk. Okay. Now, for some reason, we didn't fund this project. For some reason. Okay. Not because of this land. Again, I'm telling, I'm lucky, but because we have given funding to some another project. Okay, which is also better in terms of return. This portion, because of this portion, this project was stuck for 7 years. This project was stuck for 7 years. Okay, what I'm trying to say, yes, you have to focus on materiality, but there might be cases, these kind of cases which you cannot control. I myself got fixed in this case. Okay, so these you have to take call. What is material, what is not material. But few things which from my experience, says sensitive in terms of environment, in terms of people, in terms of regulations. These are very sensitive. Big company gets stuck in this. Okay, so that's a key takeaway. Okay, always. Okay, now your question is which one you should focus on. You should always focus on those which you think might impact your business. Okay, the high risk means it should impact your business. If you think that it will not impact your business, ignore that. Okay, that's my simple answer. Okay, can we move? Can we move? Okay, now going for this, the question is that your risk will also depend on these factors. Okay, You know that all the business have to follow this path. All the business, even as a professional, you have to follow this path. When you start a job, your salary will keep on increasing faster. 50%, 30%. Then slowly, as you become bigger, your salary will not increase by that high number. Okay. So this is what happened with the company. This is what happened with the country. So your risk will also depends upon which stage you are in. You are in the startup stage, you are in the growth stage, you're in the maturity stage, or you're in the decline stage. Okay, what is a risk? What is a major risk in the decline business?
The future, the prospect.
The revenues, right? The falling revenues and increasing cost. Okay, growth business, what is the future? What is a major challenge of growth business?
Competition.
Competition, what else? Funding, expansion, your execution, right? Execution is the biggest challenge. Your competition and your execution is the biggest challenge. When you're growing, revenue is never a challenge. Do you think revenue is a challenge for growth business? Answer is no. Okay, your execution, your competition, your cost management, your fundraising, those are the challenges which you face. Okay, when you start up, you have your another set of challenge, right? Your team, you have a team challenge, you have funding challenge, you have a product challenge. You don't know whether your product is ready or not. And maturity stage, what is the challenge in maturity stage?
Product innovation.
Products, your product, your revenues, right? These are biggest challenge. Okay. Now your risk depends upon this and also what kind of businesses you are in. Okay. Like I said, if it's contractual business, let's say a toll road. What is the risk of toll road? General risk. Do you think revenue is one of the risks, right? Revenue, whether toll will be, people will accept or not. The second important risk is tomorrow regulatory risk, right? Tomorrow government will say, okay, get lost, I will take your toll. Or you may not be able to service your bank loan because your traffic is low. Cost, there's no cost, right? Except the one important risk in the toll road is your execution risk. You don't do construction on time, right? Your project delay. Project delay means more cost. You're getting my point? So in few business, contractual business, the risk is on the execution side, on the revenue side. Okay, cost generally I have not seen much of the impact on the contractual business. Okay, capex is a problem. Okay, now if you talk about Alpha Mart, again, the different kind of risk. So you have to decide what is right, what is wrong. Okay, and like I said, I always go what is material. Pick up 5-10 material, try to go deeper into that. Okay. Okay, this we have all, this you guys know, right? Industry structure. Okay, this is Porter 5 forces. Can you give me example of this? First, suppliers. Which industry you think have very good control over the suppliers? Which industry you see have very good control over supply? Supplier mean people who supply the material. Which business has very less, no control? Okay, let me change this. Okay, Adaro. Let's say Adaro. What do you think, Adaro? The supply strength is high or low in Adaro?
Supply high.
Supply. So who controls? Adaro control, or Adaro, from where they buy the coal mine, let's say they also buy, they have their own mines, but let's say they also buy from outside. Who has more bargaining power?
PLN maybe for the end customer of Adaro, because they have their own coal power generation.
Okay, so they have their own control, right? So Adaro has more control on the supplier, right? Because they own their mines and they negotiate on better terms. So their supply has less, right? Now in customer, who has more bargaining power, Adaro or buyer in the market?
I'm sorry, sir.
Customer.
Customer, yes, they're mostly a power generation company, like PLN, or maybe for overseas customer, because Adaro has lower coal calorie, and then they find power plant that consume lower calorie of coal.
So you think Adaro has that bargaining power or not?
In terms of supply, yes, they have, but in terms of price, and maybe they have less bargaining power.
So in the coal business, in the commodity, generally they don't have control on prices. Always remember, commodity, you cannot control the prices. It's all market driven. How big you are Shell or British Petroleum, still you have to sell at market price. Nobody will buy oil from British Petroleum because they're British Petroleum. Getting my point? So Adaro, in terms of pricing, they don't have control. Supply, you have control, right? You rightly said. Okay, now substitute. What do you think for Adaro?
Substitute, yes, actually they has a competitor with the local calorie, Bukit Asam, but in terms of maybe the location quite different, because Adaro is in Kalimantan, while Bukit Asam in Sumatra.
So, but substitute, no, substitute is not the competition. You're talking about competition. I'm talking about substitute mean, is there any other product? The coal energy, coal power, coal, there's a substitute for coal? The answer is yes, right?
Renewable yes. There's
everywhere.
Gas power plant, yeah.
Yes, you know that globally, all the countries have decided to reduce the coal consumption in next 20-30 years. So Adaro is the biggest threat. Okay, so if you have to take a view of Adaro for next 20 years, it's the biggest threat for the business. Okay, India says that by in next 50 years there will be zero. China says in next 30 years there will be zero, and they are all major consumer. Okay, and new entrants, yes, there are barriers, but I think you can easily find new entrants. It's quite open business, right? Now, if you see this, if you analyze your company based on this, you will find that how strong your company is. But again, this is an industry. This is more on the forces, market forces. Okay, this is not internal. One is external, one internal. Like in the morning, somebody was saying pestle, right? Pestle is one way to analyze the company. This is four, five forces. Michael Porter 5 forces is again another way to do the analysis. Okay, and final is the industry rival. So this is basically tells that how is the degree of competition in the industry. Okay, so I think this one. Okay, my question now. Let me put this one. Okay, now I want to ask this question to you. Okay, can you see this data?
Yes.
Okay, this data is into into INR million. Okay, so for time being, assume this is a million. Okay, 25 million, 34 million, 46 million, 62 million, 81 million. Okay, clear? Okay, this data. Okay, this 5 data. Let's say if I come to you and I say, I'm looking for funding of I'm looking for funding of 15 million. Okay, looking for funding of 15 million. Okay, in 2009. What do you think? What is your view? You can give this funding to this company, cannot give.
Is there any balance sheet figures?
Balance sheet figures are equally good. Assume the balance sheet is quite healthy, okay? So they are zero debt company because huge cash. Huge cash, zero debt company.
So I think 15 million, that is still okay, since its operating cash flow is around almost 14 million.
Yeah.
So they have strong capacity to repay it.
Okay. Anyone has another view? Anyone has another view? Anyone has another view? Please. Anyone has another view?
Could you share again maybe the
Sorry?
spreadsheet? Could you share again the screen? I think there's like
Yes.
a higher gap between the operating cash flow and the operating profit.
Yes.
To the
So,
earlier
but there's no debt. Huh? The company don't have any debt, and it's a professional driven company. Okay, and it's a very professional driven company. The founder owns around 10% equity, 5 to 10% equity, and very professionally run. Will you give funding to this company 15 million? You think it's okay?
I'm sorry, I need to clear. Is it in thousand?
Sorry?
Is it in thousand?
This is impulsion me?
Is it in thousand? I mean
in million, I think, yeah.
In million?
Yeah. This is 25 million. The sales is 25, 34 and this. So
okay, well,
like you said, operating cash flow is 13 million. The company has come forward 15 million. Do you think it's a good company? See, ROC is very good, ROE is very good, the growth is very good.
Yeah, I think it's very good. The growth is very good also, and actually the net profit also can repay for the debt itself. I mean the 15 million.
Okay, so you think it's amazing business, right?
Correct.
Okay, good. Okay, you know what is this company name?
I don't know.
This is one of the biggest fraud story in India. Have you heard about Satyam?
Oh, Satyan, yes. It's backwards.
Okay, so I'm going to share one note with you first, okay? I want you to just spend 5 minutes on that and then we'll come back, okay? Now, because we are going into the financial and the data and analysis, you should understand how to take the data, how not to take the data, okay? Just give me 2 minutes. So the story which you have seen is one of the biggest fraud of India. And this is done by one company called Satyam, okay? You guys can read that later. But now let's discuss this. Of course, I want to discuss with you a few points as well. So this company, suddenly what happened in 2009, the founder came there and he said that, I have been doing fraud in the company. Okay. And there's a $1 billion hole in the company. Me, $1 billion is not there. Okay. So this, of course, the numbers are into INR. I have not told you conversion, just for your, but the concept is that this guy suddenly a business which was audited by PwC, the business which was considered as a best business, they won many awards, has reported this kind of fraud activity. Now, my question to you is, how do you understand whether the number is correct or not correct? Okay, now this is linked to your analysis. Okay, so now I want you to just spend 5 minutes on this. Just 5 minutes, just quickly, and then we'll start. Okay. So can you see this? Okay. So this is, of course, whenever you get time, please read this. This is very interesting. Whenever you get time, okay, after this course, please read it. Ideally, I would like you to give some more time to discuss within your team. I will discuss this next session, okay? So you please read it. Okay? Now, if you read this is just, forget about this study and all this thing. Just read about this data. So these are the financial performance, okay, which I was talking about. Okay. These were the financial performance about the company. Okay. The company doing extremely well. Now, he was the founder, okay? He was a founder, Ramalinga Raju, okay? And the best is that this is a letter which he writes to his board after doing a fraud, okay? And see, he's saying that this much cash, okay, this was $1 billion cash at that time. This was $1 billion cash, okay? Audited by Big Four. He says that $1 billion cash, which were in our balance sheet, which you saw, is actually there's no cash. Okay. So now question is, A, if there's not cash, where is the cash gone? Okay. B, how is the cash generated? Right. So then he explains that there was actually no cash. So he didn't take money. He didn't take money. There was no cash. He was making investor food. He's putting money, he's raising the fall bills, reducing the cost, reducing this, inflating this, and everything was audited by Big Four. Okay. So if you see this, and you know what was the best part? This guy was only holding 5% equity in the company. Everything was held by investors. Okay. He was holding only 5% of equity. Everything was held by investors. Okay. And then this is what he did. So you guys need to read this portion. So can you just quickly, from this page 17, can you just quickly glance? They are like 12 points. Okay. Now it is till this point, 17 to this 21 page. Okay. Can you just quickly read this 17 to 21? 4 page only. Okay. So this 17 to 21, just read this quickly. I'll give you 5-10 minutes. I've sent this file to you on the chat.
Could you resend it again, please?
I'll send you. Okay, I have to close this file then. I sent it. Okay, so you have to read from page 17 to page 21. Okay, 4 page only. And then when you have time, you read all. Okay, it's very interesting how this guy did the corporate fraud under the very amazing books of accounts.
We don't receive it yet.
Could you share the file in the
I'm
chat?
sending to Marshall. Marshall, oh sorry. Okay. Marshall, can you send to everyone, please?
Okay. I just realized. My bad. Wait.
Sorry. Okay, Marshall will send to everyone.
Okay.
Thank you, Marshall. So sometimes too rosy picture should raise a red flag, okay? When everything is good, you should be suspicious.
Too good to be true.
Okay? When company is saying they're making exceptional profit, they're doing better than competition, everything is there, you have to be suspicious. Okay? Like I said, they cannot be perfect, you know. No business can be perfect. If somebody say we are perfect, you know, very difficult to believe. I've never seen a business which is perfect. So quickly read this, then we discuss. And then I'll tell you how you should avoid few things and when you do or get the data. Okay. So if you see this, the first thing, okay, he created multiple companies. Okay. What he did, he created multiple companies. And the companies moved fund from one account to another. So related party transactions. Okay. So he did billing to one company, the another company billing back to this company. Okay. He was booking revenue from one company, taking cost from another company. Everything was, all the fraud activity was within his own network of companies. So wherever you see lot of related party transaction, be suspicious. Okay, you see this? He had 327 companies. Okay, you see this? So the money was moving from one company to another. Okay, the second thing, cooked up books. I'm just highlighting the important point. Okay, okay. Now you see this? Inflating the cash balance of this, the total assets was around this number, okay? Forget about it. And cash balance was this. So company basically has a cash balance, actual cash balance was 300 only. But in the accounts, it was showing 5313. And you see this? There's a two set of books of account. One was called My Hub and one was actually. So he was, somebody behind the system was cooking the books. And this was, again, like I said, you know, where he was just holding 5%. You see this? So what are the factors? Overstating the revenues, profit margins, ghost employees. So he was giving salary to someone, but the salary was not going to someone. Amazing, right? You're giving salary to someone, but there's no one behind who's getting the salary. You are getting salary. Okay. Now the other thing as well. I just touched the important point. Okay. You see this? So only few people who had control over accounts was managing everything. Only few people. So wherever the accounts and internal controls are not strong, it should raise suspicion to you. Okay. Now you see this, all of them were fooled. Auditors were fooled, PwC. Surprising, okay? Anyway, now where this fooling has come here. You see this? So what they did, okay, what actually happened, actually, I'll just give you the fact. Satyam, they made a false bank certificate and they gave to auditor that, because you have to do loan confirmation, right? Any of you, you know that, right? Audit, you need to do loan confirmation. So whenever the auditor asked for loan confirmation, Satyam printed this bank statement and gave to the auditor. And the best part is PwC always relied on that. They didn't talk to any bank. Such a huge money. Okay. This falsification of bank account. Okay. Then this fake invoices. All the fake invoices were done by them between their project, between their own company. You see this? There were 7,000 fake invoices generated. Okay. Fake employees. The real number was this, but claimed that he has this much. So 10,000 fake employees account was created and salary was moved into that account. Okay. You see board of directors, all chairman friendly board. And he only had 5%. That's why after that people are saying independent, but still 90% of the company, they bring independent directors are those who are friends and families. They don't bring any independent directors. Still now, they want some recommendation or someone they have a comfort. Okay. The director acted as a rubber stamp. By the way, all the directors put behind the jail. All the independent, non-independent, everyone. So many a time people tell that, why don't you become director? Because generally, people, they like to be independent director in this. It's actually a very dangerous job. Okay. So if somebody invite you to become a director of the company, independent director, think 2 times before going into that. Okay, director come with a lot of liabilities. Okay, now you see this. All related company. All related company. The transaction was done. This was a related company. Transaction was done between the related companies. Okay. Independent director role was nobody questioned anything. Whatever he was doing, he was allotting the share options. You see this? He was doing whatever he wanted, no clarity. Okay. Tunneling strategy. Okay. So what he did, he reduced his shareholding. Okay. And then based on that, he wanted to also acquire different companies and try to merge at a higher valuation. So acquisition is one of the very important way of cooking the books. So whenever you get merger acquisition, please have your red flag on. Not all acquisitions are good. It's one of the very important way to cook the books or adjust the books. Okay, you see this? He wanted to do this acquisitions. So you can read all this thing, okay? His shareholding was only 2%, okay? Insider trading, okay, this you can do. Okay, now what was the interesting thing for you guys? This is most interesting. You see the gaps in the earning and cash flow. We all talking about cash flow, right? Now see, he's a very smart guy. Okay, he know that someone like you guys will find it. So his cash and this all went together. You see this? He didn't create the working capital. He created the cash so that he cannot be caught. No, we were talking about cash, right? the cash and working capital was both going properly. So he ensured that nobody ever can can find this. Because if I increase my income, but I decrease my cash, okay, what will happen? You will red flag, right? If my profit increase, right, and my cash flow, it goes down, right? But he was very smart. He ensured that both move together. So my question is, then how to find this? Very difficult to find, okay? And finally, the role of auditors, okay? So anyway, so these are the few things which are there, audit committee and all this thing, okay? Now, point is how people cook books. Very simple point. Okay, what is your view? And then I will tell you my view. How people cook books. Any idea how people cook books? How people cook books?
How people cook books?
Sorry?
Yeah, by overstating the revenue and also understating the expenses.
Okay, that's one way. What else? Creating fake sales, yes. Very important, overstating this. Okay, what else?
Yeah, creating artificial sales from related party.
Relative transaction, okay. What else? Okay, can I tell you one secret, okay? So, because I've also done a lot of forensic as well. When does all this transaction happens? When does all this transaction happen? Generally, human psychology is, when does all this fake transaction happens? Any idea? All the fake transactions generally happen in last few months of the books closing of accounts. Generally, because you don't plan full year. You don't do full year until you have to make, general reporting. But generally, most of the transaction, if you have to find real thing happening, see last 1 or 2 months, you will get a lot of data. Okay. Now, like he said, one way is to increase the revenue and reduce the cost, right? Under reporting of the cost. Okay, that's one way to increase the profit. Okay, another way to do is, what is another way? Can you explain? Can you explain another way? Okay. Tell me, can somebody explain me this one? Inventory. Okay, have you guys ever, how inventories are valued? You know how inventories are valued? Inventory. Have you done any rating for any manufacturing company? Commodity company, you have done, right? Commodity manufacturing. So you see the entry value over there, how it's arrived? How it's arrived? Any idea how it's arrived? When you see that closing balance of the inventory or opening balance of inventory, how that number is arrived? Who checks at that number? Anyone? Anyone?
Inventory, you means the finished goods inventory, right?
It can be finished good, like, like coal, raw coal, palm, or let's say some, products, like a work in progress, finished good, raw material. Who checks that?
The management's policy regarding the account.
So it's management who does it, right?
Yeah.
Do you think auditor check? Do you think auditor checks it?
No.
Auditor checks it.
Auditor checks the method.
Auditor checks it.
Checks the calculation and also the physical. Yeah.
No auditor does. Auditor just do a calculation. Okay, tell me, how do you calculate the value of, let's say you are into chemical business, you understand? Chemical business, or let's say you are into manufacturing. You go to this factory, like, let's say car manufacturing, or, I visited some factory in Nike. There's so many small pieces. How do you value that? Who does it? Who is expert? Do you think I'm expert to know what is the value of that chemical, quantity of chemical, price of chemical? Is it easy to do? Can you value how much inventory Adaro has as of now? If you're auditor, will you go and see all the different location, go do that? So all these are management. Very easy to manipulate. I tell you, very easy to manipulate. I have seen in front of my eyes, it got manipulated. You tell me, who tells you that this is a fair price of the inventory? Not possible. Okay. Now these are loopholes. See, accounting standard are bringing. Okay, they're bringing people. They're changing it. Like they're changing, but few things they cannot change because it's not possible to value the inventories. Third-party valuation is not possible because it's expensive, time-consuming, and you don't have expertise. Okay, so here biggest loophole where you can do, or you can manage your accounts. Okay, now here, if you want best you can take just management letter. That's what auditor do. They take management letter, representation letter, nothing. Okay, I'll give you my example. Okay, and this is when I started my career. Okay, I just started. I joined garment company. Garment manufacturing. So I joined a company which was doing a garment business. Now, when I was doing this work with them, and this was my first job. Okay, so I was with them. Okay, so I was with them. So and this I have seen myself. My inventory was, let's say, for 40. Okay, and my company gave to bank. These are the numbers. Who will check? Bank people. Okay. My question: are you guys, in working capital loan? Working capital loan, like working raw material and all this thing. Who sanctioned the loan? Bank sanctioned the loan, right? Now these are based on your working capital. Do you think any bank officer has capability to understand the business and raw material and pricing and quantity, anything? You tell me. Any bank has that knowledge? Answer is no. Okay, and this I have seen my company doing when I was in this business, when I started my career. So those things are very prevalent. Okay, so next example is depreciation. Okay, depreciation you can do either accelerate your depreciation or reduce your depreciation. Okay, if you don't want to show profit, you accelerate your depreciation. If you want to show the profit, you increase it over the longer period of time. Okay, now this one is very important. This one, you agree with me or not? Capitalizing revenue for for the capital expenditure? Yes. Okay. Intra-company sales, very important. Okay. Now, equity accounting, joint ventures. Okay. Not consolidating the accounts. You know, there are many companies. I have done a lot of transactions. Many companies, they just want, some companies, they just want to hold this one. Some company wants to hold this one. What is the difference between these two? Very small, right? But huge impact. It's not even 1% difference, right? But many company does it. Many companies, big company, they do it. So when you see some transaction which is like 49.99, you should start questioning that. Okay, that you should technically you should consolidate this because it's technically same, right? They will say accounting wise, yes, accounting wise, but as an analyst, I should take as a majority control. Okay, and there are a lot of off-balance sheet item, you know, SPV transactions, creating a small SPV and do. Okay, I'll give you one simple thing. Okay, let's say think like this. If you go to Mauritius, you know Mauritius. Okay, Mauritius is a tax haven, right?
Yeah.
Okay, Mauritius, you don't have capital gain tax. Indonesia, you have capital gain tax.
Yes.
You have, right? Okay, Mauritius, you don't have. So you can buy, sell. That's why Mauritius is a tax haven. Okay, there's no capital gain. Now think like this. Okay, I'll teach you one creative accounting. Okay? Let's say I create a company in Mauritius, XYZ. Okay, in Mauritius. Okay, so let's say owner is Marshall and Yogi. There are two owners. Okay, and they both have put, let's say, $1 capital. Okay, clear? Okay, now let's say, you know, this company, then Yogi with $1 capital, they started the company, but Yogi has got some money. With this company, they buy apartment of $20 million in UK. Okay, and all the money is put as a loan, or this money has put as some kind of, you know, investment, or whatever you want to put. Okay, clear? Okay, now if you're in the tax haven, okay, you don't have to worry about your capital gains. Okay, now in this, what I can do, I will go to Yogi. Let's say Yogi is my good friend and he wants to give me this $20 million as gift. Okay, what Yogi will do, Yogi will just transfer $1 share to me. He take $1 from me and he will give 50% equity to me. Right? Marshall will do the same thing. So by paying $2, I can be the owner of this company. Okay, so there's a loan now, right? Now loan I can write off. Loan I can write off, right? In private company, there's no rule which says that you cannot write off the loan. All right? Agree? So by just paying $2, I become the owner of $20 million. Now this is called SPV transactions. Very smooth, smart, and efficient. And that's why all these countries are called tax havens. Because if there's no capital, nobody questions you. Clear? Okay. Now the other way also, like, you know, posting of fake invoices, which we already done, inadequate provisions. Okay. Now one of the important thing in construction business, Now, how do you manipulate your book in construction business? How do you manipulate your books in construction business?
Accelerate the construction progress.
Sorry, loudly.
Accelerating the recognition of the revenue from the construction progress.
Yes.
Revenue inventory, revenue on site, yeah.
So basically, in construction business, you overestimate or underestimate based on your need, because construction revenue is booked on the percentage of completion. Have you heard of this word, percentage completion? Okay. Now let's say I want to book profit this year. What I will do? I will do more completion. Easy to get completion certificate in Indonesia. Who can check how much percentage completed? Are we expert? Can we question? It's not 50, it's 55 or 55 or 50. We're not expert, right? Let's accept the fact. If the bridge is half completed, not legs are not there, or something are not there, how do we know it's 50% complete or 40% complete? Again, I'm just trying to give you an idea that next time when you encounter this question, you have to decide whether it's 40 or 50 or what. Because it's very difficult. Okay, now you may rely third-party report, but the report has to be very genuine. Okay, not from the small guy who is not reliable. Construction company majorly do like this, majorly. Okay, now these are the few ways which you can manipulate your books. Of course, there are many other ways. Any other ways? You guys have any idea? You want to add this? Please go ahead. Any more ideas? Any more ideas? You guys have become silent. That's dangerous.
My question is, Nitin, is us as a credit analyst, how do we identify a fraud potential, the potential of a fraud? It's like hindsight 2020. It's more easy to look back, yeah. But before it occurs, or like I don't know in the Satyam case if there is a whistleblower, yeah. But we have dealt such a similar case in Pepindo, but that is because there's a whistleblower. And hindsight 2020, it's more easy to dig on those things because we know there was a fraud, but prior to that, it was audited by a Big Four. That we rely on those reports as well, even though we also like skepticism, professionalism, but at the end of the day, we rely on the audited reports, yeah, and it was reported also by a Big Four company. So that is the challenges that we face as a credit analyst. How do we become, or this is too good to be true, we have to dig more? Yeah.
Okay, so I think frankly speaking, okay, few things which you need to understand. Okay? Like I said, fraud is very difficult to detect, and I can tell you, I can tell you a lot of logics, but it's very difficult to detect the fraud, and especially when fraud is done by smart people, and smart people do fraud. Fool don't never do fraud. Okay, no fraud is done by fool ever in this world. Okay, now it's very difficult to detect because you don't have access to accounts. You don't have access to them. You're just relying on the financial statement, right? That's what you do. Now, then how do we identify those fraud? Okay. Now, like I said, we cannot identify, but there are few red flags. Okay. Now, what are the red flags? Okay. Let's say if I have to see the red flags. Okay. One, that company is doing very good as compared to the industry. That's a red flag. Doing bad, you still know it's doing bad, right? Industry average still okay. Okay, if company is doing exceptionally well, okay, that's for me a red flag. The second red flag is for me is a related party. I'm very scared of related party. Okay, I'm very scared. If any related party transaction comes, I just go deeper into it because I cannot leave it. Third, where the management has too much of control on accounting and finance. Too much. Management will not allow you to talk directly to accounting people. Management don't allow you to talk to the auditor. Some kind of wall. That's a red flag for me. Okay, why someone will not allow you to talk to your accounts? There are a lot of teams. They say, okay, you talk to me. CFO will say, you talk to me only. Okay, you don't talk to anyone else. For me, that's a red flag. Okay, another red flag, like if you in the Satyam case when you read, see, if company is generating profit, okay, the company should also generate the cash. Always remember, if company is generating profit, the company should always generate the cash. If company is generating the profit but not generating the cash, that's a big red flag. Something is wrong. Okay. And last thing, where all the adjustments are done. Where all the adjustments are done? In your current asset and current liabilities. Generally. Because that is the only place where you can park everything. Okay. So for me, again, like I said, when you analyze things, it's very difficult to give you all this data, but this, from my experience, it says that whenever you feel any kind of thing which is too perfect, that is a red flag for me. Anything which is away from the normal is a red flag for me. Everything which is even low is a red flag for me. So if you see some numbers which is very perfect, like I tell you, like sometimes, you see margins 17.2, 17.1, 17.2, 17.9 operating margin. It's a red flag. How can you be so sure or have this perfect margin for 5 years? Do you think it's possible in business? It means that books are cooked in complete. Okay, when I say cooked, I will not say it's a fraud, but it's a managed. It's not the true picture. See, I was analyzing one company in Indonesia. They are an FMCG company. The operating margin for last 5 years is 17.5, 17.2, 17.3, 17.5 years. So of course he's not doing fraud. It's because it's just family-owned business. But I know he's adjusting the profit to manage his tax. Getting my point? So there are a lot of ways you have to identify and see. These from me, these are few broad guidelines. Of course, they're all other as well, which I'm going to do. Just share your screen with you. Okay, any more questions?
Nitin, yeah, just to follow up on that, because you said that anything that is performing well above the industry average is a red flag, yeah. So what about in this case that we have in Indonesia? We have a property developer, which is BSDE, Bumi Serpong Damai, if you're familiar with. They generate, let's say, a gross margin of above 50%, which is way above industry average, industry peers, or let's say way above the peers average, yeah. But there is a rational justification for that. Let's say because of what they sold is landed residentials, which generally generate high margin, and they have these strong branding. So it comes with a premium as well by selling their products. So yeah, and they did that with a good. I mean, almost over the past 10 years, they have a stable and high gross margin. So should that be considered a red flag?
Okay. When I say red flag, I don't say it's always fraud. Okay, that's what I told. When I see margin very stable, it's not that they're fraud. It's cooked. When I say it's managed, okay, let's me put like that. So when I say red flag always doesn't mean fraud.
Okay.
Red flag mean you have to investigate more.
Okay.
Okay. Not all people are fraud. That's wrong assumption. And that, I don't think so. You should start with assumption that everyone is fraud. That's a not good way to do analysis. The good way to do analysis is this a red flag? I need to investigate more or take more data till the time I'm satisfied. Okay. And then if you feel that you're satisfied, like you are saying that, the company is saying some rational, you take data for that. You see whether company has that kind of cash flows. Okay. If you see that company has that kind of cash flows, see one of the thing, one of the side, let me tell you, this I've experienced. Tell me one thing. Company making good operating cash, the cash balance is growing, but company is taking up more loans. What are these? It's not possible, right? It's a red flag, right? You should find what if you have cash, why you're taking loan, you should repay your loan, right? Every year increasing the cash balance, but you're increasing the loan. Okay. Another thing, company in the development stage, raising the capital and giving the dividend. So, you have to understand the connection, there are so many examples. You have to understand, does it make sense? A company who is in the development phase, raising money, is not even achieved the optimum capacity, still need money to expand, giving the dividend. Ask the question. Because, for me, these are not normal things. And as an analyst, that's what I'm trying to say. You have to ask your question. Is this okay? Is this normal? If answer is yes, this is normal, please go ahead. If answer is no, this is not normal, you have to investigate more. And that's what is a red flag to me. Okay? Okay. Any more questions before we move? Okay.
I have a question, Nitin.
Yeah, please go ahead.
Yeah, you mentioned about the equity in joint venture, and we have to consolidate that company. But how to communicate to the client to provide us the data? Yeah, since sometimes we had some difficulties to get the data aside of the rated companies.
People don't like rating people. Company don't like rating people. You know that, right? Company don't like rating people. Company like banking people. You know that. If the same question bank will ask, they will give all the answers. Same question rating will ask, they will change the rating provider. That's a problem with your business. Okay, because you are not providing any tangible benefit to the company. And this is a fact of industry, right? So let's say if bank asks this question, company will give all data. If rating company will ask, they say, why are they asking so many questions? Okay, if they don't want to go, let's go to another rating company. And that's what I have also faced in my life. Okay. Now what you are telling is right. Okay. The company will be resisting these kind of data, and they will question you. It's very difficult to convince company that, okay, because you're 49.9, you have to consolidate. He will say, why I should consolidate? As per law, I'm not required. Technically, he's right. You're also right. Okay. You cannot force this to company. Now, what you have to analyze as an analyst, that if by consolidating, your answer is different or not. Okay. Now company will never give you the consolidation data. You have to ask the data of that other company and do your analysis yourself. And then decide that this consolidation will impact the business negative or positive. If it's a negative, you put like this. If it's a positive, you ignore. So the adjustment of consolidation, right? So if it's not consolidated, you just take the profit and investment. That's it. If it's consolidated, you have to take all the debt level, all the asset, everything will come in your balance sheet. And you have to create a minority interest. So suddenly your balance sheet gets inflated with the debt. Getting my point? So that is important. Actually, this is important because, sometimes I've seen many companies, wherever there's a debt, they will say, okay, we don't want 50, we have to consolidate, put it 49. So the debt is not come on the balance sheet. Sometimes it's a high profitable company will say, no, please give us 50.01 so that we can consolidate. I have done both structuring in my life. So, people do, and technically they are right. So again, like I said, it's your call. If you ask me, I will, if somebody is coming with 49.49, I will still consider as a consolidated balance debt, consolidated level. I will always see that as a consolidated. That's my way of doing things. Because like I said, I don't, okay, sometimes we follow books, okay? Sometimes we have to apply a logic. So sometimes we have a rule, right? We have to follow the rules. But sometimes, there are gray area where you have to apply a logic. And there where you, see again, you put that, okay? My point is, as an analyst, what we should do, we should put our point, right? Maybe committee will not accept, that's committee job. Okay, your boss will not accept, that's your boss headache. But you do your work as an analyst. You put everything proper, give it to that, your role is finished. Now, there's another role for your senior to take care of. But you do your job with perfection. Then you will improve as a professional. See, then your analysis will be good as well. Your boss will also like it, right? If you give your boss this kind of analysis, I'm sure that he will be very happy, even though he may not accept it, but he will be very happy to take this answer. So you please do your analysis properly. That's my question to you.
Thank you, Nitin.
Okay.
Sorry, Nitin, but when you put the numbers again on the book, let's say when you reconsolidate again the 49%, do you put all the, like let's say 100% and put the minority, or you only put the portion based on the ownership?
No. So consolidation, you have to put all 100%. You have to get minority interest.
Oh, okay.
See, that is the game, no? If I have to take proportionate, that also you can take. People, that also they can take 49. So there are two ways to do. You can either take 49 and take that kind of debt and revenue, that is all the game. Or you can take all and you can get a minority interest. Okay? But like I said, what you want to take depends upon you. As per law, you're not required to take. Accounting standards say you don't have to do consolidation, right? But when I have to do it, I try to see at the total level. Okay, now this also depends as who's your partner, other partner. Think like this: if Astra Group has developed a project, okay, a power project where they are owning 49.49 and 51 is, let's say, they are done with some small businessman, theoretically. Okay. Now tell me who will be more liable for the debt tomorrow if anything goes wrong? It has to come on Astra. If there's a small group of businessmen who's there, if they're taking big debt and developing a project, big project, if tomorrow any problem, who will take the lead and take over, manage the entire process? This has to be Astra, right? Because they are bigger, they have more balance sheet size, they have everything, right? So technically you have to take that. So again, I don't say that I do every time. Okay. Again, I'm trying to give you options. What option you have to choose, that you have to decide. Whether you think that this is right, we should do it, you do it. If you think that no, this project is too small, consolidation will not impact, leave it. If this project you think is very critical, I think consolidation has to be done, do it. No, let's say Astra Group does one partnership with Pertamina, theoretically. Okay. Now Pertamina is a big one, right? Why you need to do consolidation at that point? They're two big partners. If anything happens, you can take care of that, right? There's a genuine thing. But if there's a structuring thing, then yes, you have to do that. You have to differentiate between genuine transaction and structuring transaction. And structuring happened when the counterpart, the other party is not very big, some related parties or someone, which that optically, this is just the people fronting. Behind there's Astra Group. Fronting there's somebody else. Okay. So
okay,
where's my friend? Huh? Oh yeah, okay, Nikin. So you can take proportionate proportionate, you only, I mean, okay, so I'm just adding my view, okay? And so again, like I said, no, you don't have to follow my view. And again, I think, so if I will take my proportionate debt if my counterparty is very big. Counterparty means other partner. If my other partner is small, I will take all.
Okay, thank you.
So again, like I said, it depends. You know, there's no straight answer. I can't give you the straight answer. Okay. Okay, so I have to
Sorry, just to touch on that. So let's say if we have small shares on such a project, let's say on the venture, we just have a 20-30% share. But given this, let's say the size of the project is significant and it's material, then we should consider that, yeah.
No. See, okay. So what is the objective of doing it? Okay.
Yeah.
So again, like I said, you understand the objective of consolidation. The objective of consolidation is tomorrow, if there is any liability, who will pay to bank? Agree with me? That's the objective, right? Why you're consolidating? You're consolidating more the as liabilities, right? So tomorrow there's a liability intake, who will take that liabilities? Agree with me? That's your objective, right? What's your objective? That based on this too, tomorrow anything goes wrong, who has to bear that? Now 20-30%, see if the 20-30% is there, and as let's say company like Astra or anyone, they have not given any corporate guarantees, or they are completely independent run, then there's no liability on Astra Group. There's no liability, right? As an equity shareholder, there's no liability until you sign. Okay. But if let's say with 20-30% Astra is running the entire business, they are operationally responsible, they're signing all the paper, technically then they are liable for the debt. Tomorrow if anything happens, they has to pay that, right?
Okay.
You're getting my point?
Yeah.
So 20-30% is not the benchmark. What you should check that who will pay this debt if there's some problem. That is the first question you should ask. If you answer this question, you know whether to consolidate or not consolidate. Okay, equity shareholder is not responsible for the debt. You know that, right? But always remember that if the group is big, the group will never do default in that, because it's also a black mark, right? Black spot, right? Do you think Astra Group will default $5-10 million in any bank ever? Even the company is not doing well, do you think they still default? Answer is no, they will never default. Because that's the credit market, that's a name in the market, right?
Yeah.
Okay, so equity shareholder is not responsible for debt. That is that. But if some big group is there, so okay, why you give AAA to big group? Because they know that even if something goes wrong, they will pay the money. Okay, so that is the name and the credit which is there in the market. And okay, having said that, that is also a blind spot for all of you. I'll give you one example, again, one example, very good example. A group, okay, a group, I don't want to name it, a group which is owned by all the big banks, all the big government banks. Okay, a group, a company which is owned by the Sovereign Wealth Fund of Middle East, a group which is held by very big financial institution in Japan. All the shareholders are the government or semi-government companies. Agree? Okay. Now, do you think they will ever default? Do you think they will ever default?
Yeah,
and they're holding majority in all the projects. You know, that's also one condition. Do you think they will ever default? Think like a company which is owned by Pattamina or Telcom all the big company, Mandri, all this, they are a shareholder. Do you think they will ever default?
Because of the reputation risk.
Huh? No, we can think, right? But actually it happened in India. The group defaulted. $20 billion. So that's a blind spot. We call a blind spot, where we cannot see the thing because we try to see the different thing. We are seeing only the shareholders, the big group, Pertamina, Telcom, but we are not seeing the business. So it has both positive and negative. So that is the view which. So in this case, you think about it. Big rating company all gave, bank all gave money to them. Rating company all AAA. Balance sheet showing highly leveraged, 7 times leverage. Debt equity 7 times. Not able to raise money, raising short-term borrowing. Okay, one of the indicators, okay, just to a red flag. Company raising lot of short-term money very frequently. That is a sign of problem. Any company which goes to market for short-term very often, there's a liquidity issue. Go deeper into it. Now, this is what happened. I'm just telling you the data which is happening. So as an analyst, please try to follow this, ensure that you don't have blind spot, because you may miss, but ensure that at least one person in your chain is more critical or can identify this kind of blind spot.
So Nitin, in the case in India that you mentioned, the sponsor didn't support and left the company in default because why? Was there no cross default or something like that?
So no, there was no cross default. So cross default was always there, right? Banks always have cross default within the same company or group companies, right? Now whenever they won the project, they went to bank, okay, and bank said, "Wow, who's a shareholder? Pertamina, Mandiri. Okay, no problem. Give them the loan, 90% loan." The problem that they were over leveraged. Bank never questioned them. Bank never questioned them. They went to rating company. Rating company said, "Oh, who's the shareholder? Oh, this. Okay, AAA." Auditor went, "Oh, wow, who's the shareholder? Okay, good. That is the problem happening. So there was not a fraud, but there was over leverage. And which is your role, right? As a rating company, this is your role to highlight that. And that's why I say sometimes, it's sad that rating company also cannot have the independent view. Because they also have many factors. I've seen myself, and this I've seen myself, I'm telling you, that rating company also have a lot of influencing factors. They also want businesses. They also want to maintain good relationship. They also have their accounts. They also have their targets. And this happened everywhere. You see the credit crisis, why it happened, 2009. Same problem, no? Suddenly giving AAA, suddenly, junk. In 3 months, junk. So it's not easy business, okay? So your job is also not easy. There's a lot of stress, I can understand. But this is how it is happening. So that's why I always tell people, you do your job properly, you don't care. Okay? You do put proper note, give it to your boss, let your boss decide. But you do your job properly. In terms of analysis, in terms of risk, in terms of data, please do your job. That will improve you as a professional. Okay? And one more thing which I always tell people, you have to start questioning. The more question you do, questioning doesn't mean that you are disobeying someone. Always remember, people take questioning as disobeying. It's not. Questioning means that you are thinking. If ever my subordinate asks me 10 questions, I'm very happy. If my subordinate say, "No, I think this we can do in other way. There may be another," I'm very happy to this. See, there's a thin line, okay? Of course, you have to respect your profession. You have to boss and all this thing. But you should question the logic. You should never question the person. Always remember this. If you question the logic, you will always learn something new. If you question the people, you will start falling. Your decline will start. Okay. So
Yeah,
please question, if company gives any data, question, not that you are wrong. You tell why you have taken this. Can you please help me with some data? Can you please analyze me? I think it should be like this. This is the way you learn. Every time you learn a lot. Yeah, sorry.
just the logic behind why the sponsor or the parent let that company defaulted, because like you mentioned before, there is a cross default clause. So isn't that enough isn't that strong motivation for the parent to support the company in case of financial distress despite being over leveraged? Or is it because of the prospect of the company going forward is not that good?
See, cross default is generally in all the loan. That's what I'm trying to say.
Yeah.
Whenever you go for a group funding, the lender will always put cross default as one of the event of default. Always. So the reason why it failed, because it was over leveraged. Okay. So that is the reason. The reason is not because, see, end of the day, if you take too much of leverage, leverage is a double-edged sword, right? We will discuss on Monday, but leverage is a double-edged sword. It can be good, but it can also be very bad.
Yes, because there's a lot of over leveraged companies here in Indonesia that we rate also, but we have behind we are of the assumption that the parent company will ultimately support this company in times of need. So that is maybe the thought process behind why the rating agencies, let's say, give the company a AAA rating company, or maybe for that particular company, the rating is equalized to the parent company or similar to the parent company, because they are of the belief that in times of need, it will be ultimately supported by the parent company, but eventually it end up in default. So that is, I'm just trying to understand why they left this company default.
Okay, so again, like I said, the company defaulted because at entire group level they were over leveraged. Okay. Now you see what is happening in China, that real estate company, right? We are talking about $300 billion debt, right? Now that was one of the biggest AAA company. Now suddenly they are talking about default, right? Now what has happened? So when you're talking about these kind of company which is over leveraged at the subsidiary level, okay? Now question you have to ask that if tomorrow there's a default, okay, do you think company will pay? The parent company will pay? Okay. If answer is yes, okay, there has to be some written document, cross default or something, right? Else, do you think company will pay for the losses or default in subsidiary? May or may not. See, if the company is leveraged on entire group level, that's a risk.
Okay.
If company is leveraged at only one SPV, that's not a risk.
Yeah.
Okay. So that the real estate company in China, it's a group level, because even real estate have a lot of SPVs, right? All the real estate have a lot of SPVs, right? Every project is under separate SPV. So one SPV default doesn't matter, group will support it. But if group level you have over leverage, who will support you?
Okay.
So you have to see whether the group level they are leveraged or not. Or second thing, like I said, if there's a cross default, see, it's not easy for everyone to come and support the subsidiary, okay? Only the good company will support the subsidiary. I've seen many big companies just let the subsidiary to default. Why somebody should pay $50-100 million for the subsidiary when they're not liable to pay? When I say willful default is not there, cross default is not there, why somebody will pay? Why somebody will pay? You think somebody will pay? Let's say holding company, the company balance sheet is let's say for $100 million company balance sheet. I mean, asset is 100 million, and there's a liability in subsidiary of $50 million. Do you think they will pay that, such a big number? if there's no cross default or there's no willful default. Willful default, you know, right? If there's a business risk, then why I should pay? It's a business, right? That's what the bank gave the money for. So, okay, one more thing. Founders are not stupid, okay? The owners of the company are not stupid. Okay, tell me one thing. Tell me one thing, okay? Tell me one thing, okay? Let's say, you know, I come to you and I ask you $50 as loan. $50 only, okay? Yogi, okay? And I take as a loan from Yogi, okay? But after 1 month, I say, Yogi, you know, I don't have money, I cannot pay. What do you think, Yogi? What you will do? I take $50 from $50 only. And I say, Yogi, please give me $50. But I say, Yogi, I cannot pay. You know, sorry, I'm sorry for that. What Yogi will do?
Nice to know you. Bye bye.
Sorry?
No.
Say, go ahead, please go ahead. What do you do?
Nice to know you. Bye.
Sorry, I didn't hear. I couldn't hear you. Go ahead.
Okay. Yeah. It's just a joke.
I can't hear you. Maybe it's a little louder, Yogi, please.
If you can't pay, then okay, it's nice to know you. Then okay.
So Yogi will say, okay, if you can pay, Nitin, it's okay. If you cannot pay, it's okay. Don't worry. Don't worry. Let's be friends. Okay, don't worry about $50 is too small. Don't worry. Right, Yogi?
Yeah.
Now think like if I go to Yogi and I ask him $500,000, he gives to me, and after 1 month I say I don't have money. Do you think he will say the same thing to me? Do you think he will say the same thing to me?
No.
No.
You got your answer, right? That is how corporate works. Understand? This is how corporate works. So until it's documented, there's some cross default or corporate guarantee, company will say, why I should pay this? Sorry, go do whatever you want to do. But if it's a small number, they'll say, okay, let's pay, even if there's no document.
Sorry, but will it affect the reputation of the group if
Yes.
they do not support
Yes.
the subsidiary?
Of course, it is a black spot. It impacts your rating. So like I said, if it's not willful, it's still okay. If it's willful, then you cannot raise money. Your career is finished. So if it's a not willful, banks still consider, but still it's a black spot. Next time when you go to bank will be a little bit cautious. Now things have changed. You know, 10 years back, you know, in Indonesia, you have so many multi-finance companies, right? And you know the state of multi-finance company, really bad, right? You agree with me? You have so many multi-finance, but how many are in a good shape? Very less, right? Now that is the error where you have done. Currently, you cannot open a multi-finance and do such thing. Because earlier you could raise money, you can do anything. Now you cannot do. All the regulators have become very strict. All the regulators, everywhere. Now you cannot just play with the money, you know, do fraud and run away. No. Those days are gone. So that's why you see now you don't find many multi-finance company coming because all those good time are gone. You have to be serious. You cannot just lend everyone and everyone and then say, okay, it's my mistake. So to answer your question, yes, it's a reputation risk which impacts. So next time bank will be a little bit cautious lending to you. It do impact. But if it's a willful, then your career is finished. Okay, any more? Okay, good. All the questions were good. Interesting question. Anyone? Last? Okay, I'll just do one small thing and then we'll close. Okay, so now this is now this is where the data quality of data will come, because a good analysis require good data. Okay, now consolidated, non-consolidated, we already discussed so many things. So you also have to see, that whether data is consolidated or not. Standalone data has less value, consolidated has more value, and consolidated also we discussed 49 and 51. Data source, from where the data is coming. Okay, now data coming directly from company has more important as compared from the third party, but data which is audited has more value as the unaudited data. Okay, of course we have a limitation, we cannot go and check each and every. Accounting policy, again, very important. Okay, the tenure of the data. Let's say data is recent data, last 6 month data has more value. Past two-year data has less value. Okay, the recent data has more value. That means the old data has less value. Then quality projections, how detailed the projection has been done, that is important. Let's say company just does projection like increase in percentages, cost, they just increase in percentage, everything percentage, that projection is not good. But company does a very detailed projection with the product, quantity, pricing, inflation, cost, sensitivity, that has more value. And like key events, what are the key events they get and analyze. So that also has a value. Okay. Now, in short, what you have to ensure that this data which has come is reliable for you and is useful for you. Okay. Okay. Now the quality of data is very important for you to understand. Now I want to start the cash flow, but I need at least 1 hour for the cash flow. I think I'll do on Monday, but I have some tasks for you. One more.
Sorry, Nitin, going
Yes.
back to the consolidated or unconsolidated things here, because maybe sometimes the management has a strategy to deconsolidated subsidiary to exclude the debt to avoid the over leverage, let's say. So in that case, maybe how to to convince to the management that we have to consolidate again the debt. Yeah, is it purely because we have to question or investigate more what will be the who will bear the liabilities, as you said previously. So, I mean, we just have to investigate more what will be the company's responsibility or liability in regards to that the consolidated project or subsidiary.
See, I think to convince.
Is there any?
So you want to convince the management, right? Okay, so I think again, to convince the management, you have to convince two things. Is tomorrow if default happen, who is responsible? Think like this. Again, like I told you, right? Astra Group and Pertamina. Astra Group don't have to worry. Pertamina will take care, right? Agree with me? Right? But if Astra Group and Nitin Gupta Group, and tomorrow as there's a default, who has to take care? Nitin Gupta or Astra? Okay, that's one thing. So that's one thing. Second thing, if there's any covenant which brings the responsibility of the Astra Group. Let's say Astra Group has given corporate guarantee. That will not reflect it anywhere, right? If they have given corporate guarantee, do you think they will tell you that they will share all the documents with you? They may not share this document.
Yeah.
Right? So then this corporate guarantee means it's a contingent liability, right? And if you're dealing with Nitin Gupta, there may be chances of default. So you have to consolidate that. Okay, I know that there won't be default, but See, when you're consolidating the debt, you're also consolidating the revenue and the cash flow also, right? You're not only consolidating the debt. So you tell him that we're also consolidating the revenue. What's the problem with you? The project is good, right? That's why you put money. And the revenue is good, everything is good. Then what's the problem? Just because of 49 and 50.01, you will say, I will not consolidate but all the liability will fall on you in case of default. That's not right. There's a thin line, right? 49.9 and 50.01, there's a thin line. You cannot say just because of this 0.01%, I will not consolidate, when all the responsibility, liability is on you. See, even accounting standard says, the accounting standard says that wherever you control the management, you still have to consolidate. You control the management. You control the voting rights. You still have to consolidate. That's accounting standard says. Even though you may not have 51. So if I control the board of director of any company, technically I'm controlling the management.
So
you cannot say
like
that because of 49 and this, I'm doing everything, but I don't want to consolidate. That's not possible.
So it's like if it's a joint control, so we'll have to maybe go back to the counterparty. I mean, if it's like a 50-50 and if the counterparty, let's say the other party is actually also from the BRIC group, then we could maybe proportionally consolidate, yeah.
Yes, again, I think you have to see, again, there are various factors, whether you want to consolidate. My simple information is that who will be responsible in case there's a default? That's one question you have to answer. If let's say tomorrow default happened, two big party, both have to put proportionate based on the shareholding, right? So you both consolidate the proportionate numbers. But let's say if everything will come on Astra, then he has to consolidate. Someone has to take liability, right? So you cannot say that, I will not take any liability. Tomorrow there's a default. That's not possible. See, but when things go bad, bank will also go behind them, right? Do you think bank will keep quiet if things go bad? Bank will go behind the management, right? Bank will go behind. Bank will take management. You have to put money. You have to do something, right? So there's a responsibility of big group when you do this kind of stuff. When bank give money based on name, it's responsibility of the group to take care of the debt. Okay, so that's why if you see the big group, you don't get those news because they don't default. Generally, if they're taking money in subsidy, they don't default. Because there's a lot of reputation risk. It's not easy. Tomorrow, Astra Group cannot say, I will not pay the money. Very difficult for them to say. Because the reputation risk is very high. They have to pay. Even the project is not that they have to do something. Invest some equity, turn around, but they have to do. There's a liability on the group. They cannot say it's not my liability. Not possible. See, this finance world is very small world, right? So you cannot just do that. So that's what I'm trying to say. You have to understand who will be responsible for this SPV default. One is the project, which is red. I agree. If you're doing the project finance, the company said that, okay, we are not responsible for everything. Everything is in the project level. You ignore. Don't have to take it. Okay. But if the group is responsible somehow, then you have to take the consolidated level. Just because you are not owning 0.01, you cannot take it. That's not possible. Or at least take your proportion of that. That's my question. See, because if there's an SPV, and especially for infrastructure projects, right? So infrastructure project, you will say that, okay, let's say road project. You say that I have taken project finance. But even project finance, bank will take comfort letter, bank will take, corporate guarantees, bank will take gross default. Everything is linked. You cannot just say that, I will default. Very difficult. If you're lucky, then yes, don't take it. So I think what you should do, Niken, ask the management to convince you why you should not take it. Okay? You sit with the management, say, you tell me why I should not take it. Okay? If he said, no, there's no, you say, tomorrow if the default, what you will do, whether you will pay or not. You ask him that, have you given any this documents or not? Show us all the documents. Let him answer, let him convince you. If he convinces you, then it's okay. If he's not able to convince you, ask him to put it. Rather, you convince them, you ask them to convince.
Okay, thank you.
Okay, but these are very, very technical thing, very, very case to case basis. We cannot generalize. Okay, I think we are done. I have to do on Monday, we have to do two things. Okay, one, we will analyze the Adaro, income statement. Okay, from top to down. Okay, we will analyze then the balance sheet of another company. I have 3-4 companies. I will share with you all of these. Okay, then we will analyze the balance sheet of one, and then I will do a very detailed analysis of cash flow. Okay. And I'm going to tell you that how cash flow is amazing. I love cash flow. If you give me cash flow, I can review it for 5 hours. I have so much of passion for cash flow statement. Okay, I will tell you how to understand the cash flow from very basics. Okay, so that whenever next time you see cash flow, you get a lot of answers there. So we will do all this free on Monday, and then we will do this one, some sector analysis. Like I have Alpha, I have some commodity companies, so I have some financial. We will discuss that financial. Monday is very interesting day. Okay, and then we will discuss what are some of the management group level. So we already discussed a lot of today, but what are group level control and all those things which impact the credit. So we will do that. So that's what we have to do. Okay, so if you have time, okay, one thing which I want you to do, because that would help us, okay, I want you to don't spend too much of time, okay,